leverage is typically debt that allows you to grow your wealth. Any technique for borrowing money that you're using to fund an investment, like a mortgage, is considered leverage. A business loan is considered leverage. Debt is considered leverage. Now, if you think about what the word leverage means, like in real life, it's like when you have enough leverage to move a rock when you use a shovel, it's because you were using that shovel as a lever to like get that rock out of the ground. And the leverage is physical leverage. You're using a tool to help you achieve a goal. Financial leverage is similar. It's just that you're using debt to achieve the goal. The goal is usually to build wealth or to have a successful investment. So it's a strategic endeavor. Welcome to Old Money, a show dedicated to helping you build the trust fund you wish you were born with. Ladies who lunch, listen up. Life is not about looking rich. I want you to build a life and a legacy that feels rich in every sense of the word. If you're ready to stack cash, talk shop, and trade insider secrets, you're in the right place. These are the new rules to old money, so let's get after it. Hello, rich girls. Welcome back to Old Money, the podcast for women building the trust funds they wish they were born with. It is me, your host, Amber Frankhusen, and I'm so happy to be here with you today. I have a really fun show planned. I had a ton of fun putting this together, and it was inspired by one of the TikTok trends that I'm obsessed with. I don't typically go down a scroll hole with these trends, but this one I have, and it is the couples dictionary, because I am obsessed with the way that people talk to each other and this secret language of their relationships. I don't know about you, with your friends, your sisters, your cousins, your partners, if you have these weird vocabulary words. But the reason I've been loving to watch other people's is because I've been getting great vernacular from it. If you're not familiar, the trend that's happening on TikTok is one person will film the other person in the couple, and that person will be holding up a phone with the screen away from them. And the person filming has written a keyword or the phrase, whatever it is that they say regularly. And they're basically playing taboo, where they have to describe the phrase or the word and get the person to guess it. And it's not a regular word. It's like the made up word or phrase that they use in their relationship. One of my favorites, as an example, was there was a couple, it was a gay couple, and one guy said, okay, what do we say when we find a really good parking spot? And the other guy in the couple was thinking about it. He's like, oh, when we find a really good parking spot, I say, ooh, I found valet. I love stuff like that. I love these little inside jokes and things. I might need to sit Justin down and actually make him record a video with me, because our list is absurd. It's mostly me speaking in baby voices to my dog. And then that trickles over into everyday life. And I will embarrass myself out on the street, out in these streets, saying things like, go babies, which is what I say to Poppy, but nobody should ever hear that. And now I also say that to Justin like 40 times a day. Or when I'm exhausted, I say, oh, I need to go CPCPs. Like, that is embarrassing. I shouldn't even say that on this podcast. It could be used against me in a court of law. But my point is this. There's vernacular with everything. There's a culture of speaking in every relationship, every friendship, and in the world of wealth. So this episode is inspired by the couples dictionary trend and also by a blog post that was written by an AF marketing team member, Stephanie. Shout out Stephanie. She wrote an incredible article about some of the language we use in luxury marketing and the very specific definitions that we use to define segments of people or marketing plans or target markets, customer avatars, whatever it might be. So after reading that and then looking at the couples dictionary, I thought this would be a really helpful guide for anybody out there in the world that's looking to be, upwardly mobile or wants to be rubbing shoulders with people who are more successful than them or doing different things than they are. They want to be traveling to new places, meeting new people. And as I always say, I like to be a little bit dangerous with all of the things. And what I mean by that is that it's good to have an overview of a lot of different, whether it's topics, ideas, and different points of view. And if you know a little about a lot, you have context, right? You have context to what it is that the other person is speaking on. And there's no expectation. And I think this is something that I even get in my head about this. Like, what am I going to talk about? And the thing is, especially when you're meeting new people, you don't have to talk about anything. You get to ask questions, but asking good questions gets you better answers, right? So if you have some context around the topics that are at hand, it's going to help facilitate a more productive conversation. We know this, how to win friends and influence people. People love to talk about themselves or what they're interested in, what they're building, what they're working on. So if you're interested in meeting new people, as long as you're asking good questions and showing genuine interest about what they're telling you, it's going to leave a great impression on that person that you're trying to build a relationship with. But you need to have some sort of idea about what they're talking about so that you can, as I call it, be dangerous enough to carry that conversation. You know what they say, money talks. So this is your dictionary, and we're going to go through a couple of different categories. I've got investment terms, I've got real estate terms, we've got shopping terms, general terms, and a lot of fun little stories tied in there that'll give you some nuggets of information so that you can have a charming story to tell at the next party as well. These are terms that are going to help you in business, in talking to clients, in talking to coworkers, and talking to bosses, of meeting your partner's parents, of summering in St. Bart's. And yeah, summer is a verb in this language. There's a lot of nuance here, right? Like there's specific things that you say. You know, when you're in New York and you go to New Jersey, you don't go to the beach, you go down the shore. Or if you're going to the Hamptons, I'm pretty sure you say, are you going out east? Not, are you going to, well, maybe you would say, are you going to Montauk? I don't know. My point is there's this, nuanced lexicon. And if you're from New York, like tell us how to say it. We want to make sure we feel good about whenever we go. There's always these little tells where you know, is this person a local? Do they know what's up, or do they have no clue at all? And here's the thing. I'm not about faking it till you make it. Don't walk in somewhere and try to be a local. Own where you're from. Own what your experience is. Ask questions. It's so much more fun and charming to be the newbie and be a tourist and get to be shown around. And people will sniff you out if you try to fake it. So don't do that. But again, be dangerous enough to have a conversation that's going to be productive in building a relationship. So let's get into it. I'm going to start with a fun one. This is actually something else from me and Justin's dictionary, couples dictionary. And this is something that we say when we're in a restaurant. I don't know, it's always in Chicago. This type of person is always in Chicago. It's a wealthy, larger man, usually smoking a cigar in the back of a restaurant. He looks wealthy. He looks powerful. He looks like he could be in politics. And he looks kind of like grumpy and unhappy. And I call him a fat cat. That is 100% what I call people that have a bad attitude that think they're really self-important. So typically a fat cat was somebody that, and please tell me that you know what this image is that I'm talking about. Somebody that was like really involved in politics. Like I said, I always think of Chicago with this, something like a colder city where there's some, bad stuff going on with the mob. But this fat cat vibe is somebody who's just grumpy and not having a good time and thinks they're super self-important and walks into a restaurant, a bar, a club, whatever, and they've just got that stank and they just think they're a fat cat. And for me, it's a negative term. I don't like that energy. I like somebody who's gregarious, that's going to be fun to have a drink with at the bar. No matter how much money you have, are you going to be friendly? Are you going to be cordial? Are you going to be charming? Fat cats are not charming. They're not cordial, and they're not fun to have a drink with. They're smoking cigars and reek of probably bourbon, whiskey, scotch. I don't know. Anyway, that's a general one, but let's get into something that's actually going to help you, especially if you're talking about investing, because these are some investment terms. So the first one on the list is friends and family. Now, you would probably hear this a lot if you were working on, an invitation list to your wedding, or if you have people in your life that are friends and family. But when you're talking about it in investment terms, there's a very specific meaning to what friends and family are. And this is code for the first round of capital raising that you might do if you are a founder of a startup, where you go to your close network, your friends and family, and you ask them for money to invest in your company in exchange for equity. The reason this is different is because, number one, it signals the start of a fundraise by a founder. And also it's the most casual of the fundraises. Like when you get into different levels of fundraising, because after friends and family, you might have a pre-seed, a seed round, a series A, a series B. And these are all just different fundraising efforts that are put on by this company, by the startup, by this founder. But with the friends and family, it's not as hardcore because they're not doing super gnarly valuations with super tight terms. And when you go through traditional raising capital, venture capital, it's very rigorous. They're like looking at your profits, your earnings, your P&L statements, that's profit and loss, your equity, your marketing plans, the cap table, which is the table that shows everybody that's invested and how much equity they have so far. It's just a bigger deal. So when you have a friends and family around, you're kind of going to your mom and dad and saying, hey guys, could you throw in 100 grand for me and help me fund my company for X amount of equity? And it's just a little bit more casual. So the reason this is important is because you might be asked to fundraise as a part of somebody's friends and family round. If you are asked that, you do need to be rigorous. And typically these are kind of like, I'll help you out here and there. You know, you kind of have that idea of like mom and pop and family friends are going to throw you a bone so that you can build your thing. But if you are serious about investing in a company, treat it as such. It has a casual name, but not a casual meaning. And here's a little fun. This is something that's been really grinding my gears, to put it as Peter Griffin would say. There's this meme going around, and it's talking about how some of the biggest founders that we know, Jeff Bezos, Bill Gates, like how they're basically Nepo babies, because when Jeff Bezos started Amazon, his family gave him $100,000 to invest in Amazon. And Bill Gates got a leg up in building Microsoft because I think it was something like his mom was on the board of directors of some place that gave him his first contract. And listen, absolutely, did that help them grow their businesses? 100%. But the fallacy in it, and what I hate to see, and this is such poor mindset, and I mean poor as in broke mindset, is people being like, oh, well, Jeff Bezos obviously built Amazon because his parents gave him $100,000 to get started. So what that tells me is that you think you could build Amazon if I gave you $100,000. Like, be fucking for real. Am I right? And so when I see these memes circulating online on Reddit or whatever, just check your energy on that. And both things can be true. Yes, it's true that it's great to get an investment from friends or family when you're starting a business, and it can absolutely be the thing that propels you to the next level. But don't assume that if you were given the same opportunity, you would do the same thing with it. We can't discount Jeff Bezos's absolute brilliance or, regardless of his politics. And if you think he's Illuminati, which I'm becoming more convinced he is, Bill Gates, these people that have become wildly successful is not just because somebody handed them money. And if you are uncomfortable asking for money, I want to remind you that every successful business, okay, not every successful business, mine's bootstrapped and I would call AF marketing successful, but most successful businesses that are playing on the S&P 500, for example, they always ask for money. Fundraising is a part of business life, and fundraising is one of the fastest ways to pour fuel on the fire of success. So friends and family is just the first round. After that, like I said, you go to pre-seed, seed, Series A, Series B. Here's another fun fact for you. Elon Musk, I don't know what your feelings are on him. I don't drive a Tesla. I'm kind of agnostic to him because on one hand, he's incredibly obnoxious. On the other hand, he kind of cares about what he's doing and like the world. I don't know. Neuralink is interesting. SpaceX and free satellite internet for the world. That's interesting for me. He's the first person who has brought, wouldn't even call it luxury, just an electric vehicle company to market at scale successfully. He's doing stuff. And just a couple weeks ago, he sent out a deck. Okay, that's another thing you should know. Decks. Decks are a big deal in investing and a big deal in fundraising. The decks are solid. The decks are very specific. They're usually like 10 to 12 slides, and there's a formula of what exactly needs to go in your deck and how it should look. And it's just a deck. It's just a PDF deck, 10 pages, and he circulated one. He sent it out to basically everybody who's anybody in the investing world. And he sent out this deck for XAI, because remember, he owns Twitter, aka X, and he's looking to build X kind of like how they built WeChat in China. So WeChat in China is this like crazy, it does everything app. It does everything app. You make payments on WeChat. So it's like Venmo built in. It's social media. So it's like Instagram, YouTube, TikTok built in. It's got messaging. So it's like WhatsApp and Apple's text message things. It's got all of these different functions within one app. And if you go to China, you cannot function in the country unless you have WeChat. And you cannot get WeChat unless somebody that already has it invites you. So if you go there as a tourist and you're not really prepared, most places that you go to for payment, that's all they will accept is WeChat payment. It's exactly what Elon Musk is modeling X after. That's why he bought Twitter, because he's trying to make it this all-in-one app. Remember, he founded PayPal, so it's not like he doesn't know how to do this already. And so this is not investment advice, but if anybody could do it again in America, it's probably going to be Elon. And I'm not the only person that thinks that, because this deck that he circulated was for XAI. And because we've seen some pretty massive failings from the AI products that have come out of Google, for example, called Gemini is the product, and it's not great. And it's got a lot of biases and it's spitting out some bad information. And so Elon's goal with XAI is to build a AI that he's going to say is going to be all about truth, and it's going to be unbiased, and it's going to be about giving facts. And I don't know anything about it, but he circulates this deck, and he was raising a Series B. So I think he skipped seed Series A and just went to Series B. And he raised what he asked for in 7 days. I'm talking about people wired the money. I'm talking Anna Delvey, wire me the money, wired him the money in 7 days. Typically a Series B, you're looking at raising $20 to $30 million. Elon asked for $6 billion and he got it. People are stoked on what he's building. The investment population was clamoring to get in because this is basically a sure thing for them. They're looking at this deck. They're like, oh shit, Elon's building this. Like, let me put as much money in as possible because they believe it's going to grow. So Elon skipped friends and family. He skipped a pre-seed. He skipped a Series A. He went to Series B, or maybe he did a Series A and I just don't know. Don't quote me on this. My point is he raised $6 billion for XAI. And so now you have that nugget in your pocket. You have the Jeff Bezos perspective in your pocket. And you also know that if you're at a garden party in Montauk, I don't know why Montauk's on my brain, probably because I've been watching Summer House, and we should talk about Carl and Lindsay, but that's another episode. Anyway, if you're in Montauk at a garden party and somebody says, oh, I'm in friends and family for such and such, you know it's not just that they got an invitation to the wedding, it's that they've put their money where their mouth is and invested it in a company in the early stages. And typically, you want to get in early when you're investing with companies because you get better terms, meaning you get more equity for less money because the company hasn't had a chance yet to really grow as much. So the more successful the company gets, obviously the less you get for your investment. So getting in early is great. And there's also that pride thing of, you know, I'm in the friends and family round. Like, I saw this before you. But I just want to say one thing too. I mean, oh my gosh, we're already 17 minutes into this episode and we're on our first term. But I think it's important is that just so you know how funds work. And when I talk about funds, that could be a person, could be a really rich guy who's investing. He's an angel investor. It could be a venture capital fund where they have a full office of people that evaluate different companies, decks, basically. They look at the decks and they interview the founders and they decide if that's going to be a good investment for the money that they raised from many investors. And then, you know, a venture capital fund usually gives money and also advice and guidance to these startups to help them grow. This could be a family office that's looking to invest in companies, or this could be referring to an incubator. There's a ton of startup incubators that exist, even locally in your city. I guarantee it. There's lots in San Diego. The more well-known ones nationally are Techstars or Y Combinator. And these are incubators where they take very young startups that pitch them to become a part of the incubator. They give them equity in exchange for the funding, right, from the Techstars or Y Combinator or whatever. And they will pull dozens, if not hundreds of companies into their fund. And when they invest in, let's call it, 50 companies, they do not think that all 50 companies are going to pop off. They need 1 or 2 or 3 companies to do so well that they cover the losses on all of the others. They want to cover and hedge their bets, basically. And not even cover the losses, is just to make the money back that they invested in everything else. So when you think about Y Combinator, which is probably the most successful, actually, I'm going to say it's the most successful, probably based on exits, most successful tech incubator. This is another keyword for you to know. It's very successful based on exits, meaning they sold their position and got the money back. And it's going to cover all the other investments on the companies that flopped because they invested in like Airbnb and Reddit and Stripe and Dropbox and Twitch and Coinbase, all these companies that have done so massively well that it's covered their investments on everything else that was a big ass flop. So when you talk about friends and family, it's risky, right? The company might not have shown success yet, but it's good to get in early because you can probably get a bigger piece of the pie. But in order to invest appropriately, as we've talked about, you've got to diversify your opportunities, right? You got to give yourself a couple more opportunities to win than just betting it all on number 13. So with that, friends and family is your first term to learn about investing. Today's episode is sponsored by Trust and Will. Yes, we talk a lot about making money on this podcast, but I'm also interested in keeping it. And that's what Trust and Will is here to help us do. You might be thinking, I'm young. Do I even need a trust or a will? Well, if you have assets, children, a business, or you just want to ensure that your money stays in your family without hassle, old money style, then the answer is yes, you do. Here's a quick lesson for you. A will defines what should happen to your assets, how you'd like to be cared for when you need it, or who you'd like to have care for your children if you need it. A trust gives you all the same coverage as a will, but it also reduces the burden on those you leave behind by avoiding probate court. If you do not know which is right for you, there's a quiz right online to help. In just a few clicks, in less than 20 minutes, you can get yourself all set with the legal protection you need to protect your assets and build generational wealth. The Trust and Will platform is truly democratizing estate planning, making it easy to access legally valid, state-specific documents that are tailored to you. Follow the link in the show notes that will take you right to the page that you need. Please, to support the show, use the link in our show notes. You can find it on Instagram at Old Money Podcast under our partners highlight or on our website at oldmoneypodcast.com. Get connected with Trust and Will and protect your assets today. These are the new rules to old money, baby, and Trust and Will is here to help. The next thing that I think is really important to know, and it's something that I say a lot, it's just a part of my normal vernacular, is the word bullish. Bullish, and then the opposite of that is bearish. I've never said the word bearish. It doesn't sound right to me, but you would say it's a bear market. What does this mean? So it's not bull in a china shop, but it kind of is. It's kind of like the charging bull. In fact, if you've ever been to New York, if you go near Wall Street, it's not on Wall Street, but near Wall Street, there is a huge charging bull statue. And it was made, it's actually kind of new. I think they installed it in like 1989, right after the recession of like 87, 88. And it's meant to instill confidence in a successful and optimistic outlook of the US stock market. So like, we love that. But a bullish investor basically means that the price of a stock or the success of the market is going to go up, or something's going to perform well. So when you say I'm bullish on something, it means that you feel like it's going to perform the way that it should, which is positive for the company, the market, whatever. So I'll give you an example, how I use it in a sentence. There is an apartment building near us. And when they first came out with the pricing, I was shooketh because for tiny little boxes that were probably 600 square feet, they were charging literally $6,000 a month. And that didn't include parking. And then at the penthouse level, I think this building's like 20 stories, 22 stories. There's a pool at the top. It's beautiful. It looks downtown San Diego. And the penthouse units were going for $13,000 a month. And that's for rent. And this opened, by the way, in 2021. So this was back when interest rates were super low. And you're thinking, who in their right ass mind is going to spend $13,000 a month on an apartment, a 2-bedroom apartment in San Diego? That's like, it's a fine building. It's beautiful, but don't get me wrong. And I'm not going to share the building. I'm not going to slander the name because at the end of the day, I love the interior design. I'm a huge fan of who the interior designer was. And I knew because people were doing well in the market. There's Bitcoin millionaires everywhere. Tech was popping off. I said, I'm bullish that this project will sell out quickly. Other people didn't agree with me. And here we go. I look at this building all the time and every single light in the building is on. They sold that mother effer out and people are paying those ridiculous rates plus extra for parking. And so I was confident that the building was going to do well. So I said I was bullish on it and I turned out to be right. Don't we love when we can say, I told you so? The opposite of that, as I mentioned, is bearish, but I don't say that word. I say it's a bear market or shit doesn't look good. I don't really know. Bearish doesn't sound right to me. But anyway, a bear market is essentially when a financial market is experiencing a prolonged decline, usually of 20% or more. And this typically goes into like recession talks, and we're looking at things like an overall market index, like S&P 500. Like if you have a decline over 2 months or more of 20% each month, you're going to say it's a bear market. As I said, this is typically indicative of downturns such as recessions. But the challenge with the word recession right now, because that's something that everybody knows, is that the definition for what a recession is has changed recently. I'm not even going to get into that because I don't want us to get triggered in this episode. But it's one of those things where we can give a feeling on the market. I think things are going to be bad, shit stinks. Or we can use terms like bullish, like I feel confident, but bearish actually has a like mathematical type of a word towards it. Like going into a bear market means 20% decline month over month for at least 2 months in a row. Isn't that interesting how like one side has an optimism and like a feeling about it, and then the other side is like a very specific term? I don't know. I just think that's really interesting. In fact, there's another term that's very similar to that. Let me just jump around. I'm going to go out of order, and it doesn't matter to you because you didn't know I had an order. But a similar situation to that is the term high net worth and ultra high net worth. These are terms that you use to speak about people's wealth. If you are talking about a high net worth person, or you might see it as HNW, that is somebody that has at least $1 million in liquid investable assets. That means money that is in a bank or that's invested and can easily be withdrawn, not personal property, real estate, collectibles. It doesn't mean business equities. It just means you have to have $1 million basically. But the next level of wealthy person, which is an ultra high net worth individual, which is UHNW or UHNWI, does not roll off the tongue at all, is somebody who has at least $30 million in assets. Not investable assets. This is not you have $30 million in shoeboxes under your bed. This is you have $30 million of assets, including real estate, your primary residence, business equities. When you get to this level of $30 million, now you're talking about collecting all of your assets together. But when you're at the $1 million mark, you can't because they treat you differently that way. And this is a high net worth individual and investable assets is typically used. You're going to see this a lot in financial institutions when they're defining the types of clientele that they will work with. So for example, if you're a wealth manager and you will only work with high net worth individuals, and somebody comes to you and they say, oh, my net worth is $1 million, but $800,000 of that $1 million net worth is tied up in equity in their home. Do they have $1 million liquid to invest with you as the wealth manager? No. That's why high net worth has a different analysis of what the wealth is versus ultra high net worth. Because ultra high net worth, that's just fuck you money, right? So that's why the two different categories are different. And I think it's really interesting to know the distinctions between them. Same thing with bear market and bull market. Okay, I have more investment terms for you, but quick intermission here. I don't know if you can tell if I'm pausing the podcast a lot tonight, but I'm eating popcorn, not on the mic, because that is cruel, straight to jail. If you guys have, super sensitive ears when you hear people eating or drinking on a microphone, it's absolutely disgusting. But I'm having popcorn and a cup of tea, very random girl dinner on this amazing evening when I'm recording this podcast, and I'm just having the best time. So I wanted to stop and say thank you before we talk about what leverage is. This is just random aside. I was just enjoying my popcorn. Anyway, let's talk about leverage. Leverage is something that is used as a term to describe debt, but not all types of debt. Leverage is typically debt that allows you to grow your wealth. Any technique for borrowing money that you're using to fund an investment, like a mortgage, is considered leverage. A business loan is considered leverage. Debt is considered leverage. Now, if you think about what the word leverage means, like in real life, it's like when you have enough leverage to move a rock when you use a shovel, it's because you were using that shovel as a lever to like get that rock out of the ground. And the leverage is physical leverage. You're using a tool to help you achieve a goal. financial leverage is similar. It's just that you're using debt to achieve the goal. The goal is usually to build wealth or to have a successful investment. So it's a strategic endeavor. It's not just I'm taking out debt to buy shit. Credit card debt is not leverage. Credit card debt is bad. When you are using leverage, you have a very specific outcome in mind, and you're going to put the money that you're borrowing to work. If you've read Rich Dad, Poor Dad, or you've listened to anything from Grant Cardone, first of all, I'm sorry. Second of all, you know these are two people who talk a lot about leverage and they talk a lot about using debt to achieve wealth. Now, I'm not here to say what's right and what's wrong. This is not financial advice. But I do know that a lot of people, unfortunately, think about what Grant Cardone has and they are like, I want a private jet too. And then they follow his advice and they over leverage themselves. And over leveraging is basically when you've taken on more debt than you can pay back, or you're not making money with the debt that you took out, or you just don't have the cash flow to repay the debt that you've taken out, or you don't have the assets to repay the debt that you've taken out. So you're basically over leveraged. I don't know. You got too many shovels and not enough rocks. Do you know what I'm saying? Grant Cardone has a lot of stuff. If you're on financial TikTok like I am, and I like to see everybody's point of view. Okay. So no matter if I agree or don't agree, I want to see what people are saying and then form my own opinion about it. And he has this series right now where he's talking to some young employees who are they're interviewing him and he's offering them advice. And he's talking to this young girl and he's like, this is how you get rich. You work for me. You get paid $200,000 a year. Don't spend any of that on your lifestyle. What you're going to do is you're going to take that $200,000 and you're going to buy an income producing asset. You're going to buy a house. You're not going to spend it on your lifestyle. And then all you're going to do is you're going to use the money that you make from the house that you bought, that you're going to rent out. And that's what you're going to spend on your lifestyle. Now, on paper, that sounds like a great idea, Grant. Like, congratulations. However, if you truly are a young person and you've gotten your first job and you're making $200,000 a year, first of all, good for you. Second of all, what do you mean don't spend on your lifestyle? Who's paying for your food? Who's paying for your housing? Who's paying for your commute to work? I don't understand the formula of getting paid $200,000 a year and then not spending any of it. Secondarily, if you buy this amazing magical house that Grant Cardone tells you to buy so that you can make all your money off of it, what happens when the water heater goes out? What happens when your renters squat and don't pay rent for 10 months? The thing that's not factored into these conversations is that real estate or any leverage tool to build a business is not guaranteed. It is not guaranteed that if you buy a house and you put $200,000 down, and you're going to put a renter in it, it's not guaranteed that they're going to pay their rent. It's not guaranteed that the house won't need a new roof. And if you don't have money to take care of those renters or to cover if something else goes wrong, you are over leveraged. And quite frankly, if you're giving this advice to a young person, they're right out of business school, they're making $200,000 a year, they probably have student loan debt, they probably don't have money in their back pocket to cover things like COVID, for example. They don't have opportunity to say, oops, there's a pandemic and the whole world shut down. And so if you were out of work and I needed to give you a break on your rent, I can't do that. Real estate's not a guarantee when you're using it as an investment vehicle. And it's also not a guarantee if you're even looking at buying a primary residence. I mean, if you're looking, and I know we have some listeners in San Francisco right now, if you are looking at the market at San Francisco, I don't know what it's signaling for the rest of the economy, but shit's going wild over there. Now, listen, I have a lot of friends in San Francisco. I have family in San Francisco. I'm basically partially from San Francisco. I claim that as my city because it's my mom's city. That's where she grew up. In San Francisco, there are multiple homes on the market today that were sold in 2019 for 1.1, 1.6, 1.4, and they're listed today for under $1 million. Why is that happening? Well, in the tech run up, especially during COVID, right after COVID, 2020, 2021, everybody's working from home. People are like, I'm doing this forever. I'm making great money right now. And also interest rates are low. I'm going to buy this house. And then all of a sudden, the tech bubble, I don't want to say burst. I want to say it corrected. And so, there was a lot of correction over the last couple of years. And whether it's people looking to move out of the city at a loss, whether it's people who are over leveraged on their mortgage payments that are too big for them, their careers have changed, whatever it is, there's also not a lot of demand in San Francisco anymore because not everybody had a return to work. A lot of people moved out of the city during COVID. And I'm not saying it's an unhealthy market, but there are a lot of things happening that are indicating to me, once again, that real estate's not a guarantee. It's not a guarantee that if you buy a house, it's going to appreciate 20% in 10 years. If you buy a house in Tulsa, Oklahoma, it might not appreciate very much at all over the course of the 30-year term of your mortgage. I don't know what's going on in Tulsa. Don't hate me if you're from Oklahoma. My point is that I think a lot of people are out there proselytizing about real estate and how simple it is to make money. And you must be so stupid if you don't know that you should take $200,000 and put it into an income producing asset and live off of the income it produces. That's not a good piece of advice for everybody. So leverage is something that's discussed a lot and it's thrown around a lot. And if you've seen these TikToks and they've made you to feel like, God, why am I so stupid? Why didn't I do that? You're not stupid. You're just not going to be over leveraged. So that's leverage. Again, don't pick up too many shovels if there's not enough rocks on the ground. I think that's really, really important. Here's another like random thought that just came in because I said shovels, but I often feel like if I drop a little history nugget into a conversation really confidently, people A, always believe it, even if I'm a little bit wrong, and B, it kind of like gets you some respect. And one of the things that I've been thinking a lot about is the gold rush back in the 1800s. If you're from Northern California like I am, I feel like I didn't learn any world history. We only talked about Sally Reed's doll and the Donner Party year after year after year, all the way through elementary, middle, and high school. Like I didn't learn anything about any other country. I just know that there was a gold rush in California. That's what we are known for. And every year we'd go to Coloma and we'd have to pan for gold in a freezing ass river and nobody found anything. And it was except for like pyrite and it was really depressing. However, back in the gold rush, there were so many people that traveled across the country in search and in hopes of gold, right? So everybody came out here and they came from all parts of the country to pan for gold in the American River or wherever else they got it, right? And so all the people that came out here, they were farmers, they were bankers, they were tailors and cobblers and blacksmith or whatever. And they came out here with the hopes of getting rich. Well, if you wanted to get rich from finding gold during the gold rush, you needed to get some supplies. You needed to get shovels, you needed to get picks, you needed to get pans, and you needed to get some Levi's jeans because that's what all the gold panners were wearing back then. Anyway, my point is a lot of people came out here with the hopes of finding gold. Many people found gold. Not a lot of people became wealthy. It was like playing the lottery, right? But the people who did the best were the merchants who sold all of those men with dreams, their shovels, their pickaxes, their Levi's jeans, and their freaking gold panning dishes. The merchants are the ones who did the best because they supplied all of the utensils that you needed in order to achieve the dream. An analogy to that is right now, everybody's freaking out about AI. Everybody's trying to build an AI tool. Everybody's trying to mine Bitcoin. So if you want to go mine Bitcoin, that's fine. It's literally called mining, just like we're mining for gold. What are the tools that are going to support the gold rush for that new idea, for that new thing, that new trend, the AI thing? Like NVIDIA supplies all of the chips. You've probably heard of NVIDIA in the news. Their stock's over 1,000 at this time of recording, or I think 1,100. And they're going to do a 10-to-1 stock split soon, meaning if you have one share of NVIDIA, whenever they do the split, you're going to then have 10. The price is going to go down, but now you own 10 pieces. And it's likely that, no, this is not investment advice. So I'm not going to finish that sentence. However, my point is NVIDIA is the equivalent to the tools, the pickaxes, the shovels, and the pans that were sold to the guys that came out here to get rich panning for gold. So I'm always asking myself, what are the companies that are supplying the shovels? When e-commerce was booming, it was Shopify. Shopify was building the platforms that people were selling all of their direct-to-consumer products on, right? So as new trends come up, I think a great conversation to ask, especially if you have a trend that you've identified in conversation with somebody, you can say, share them with them that little anecdote and say, what do you think are the shovels and the pickaxes? I think that is a great conversation starter in business and makes you look really fucking smart. Speaking of really fucking smart, the next term, one of my favorites, if you have a little girl who's obsessed with these, you're not alone. I'm obsessed with them too, but in the business sense, it makes me think of Justin's sweet little goddaughter, Noelle. Shout out, Noelle. I love you. She is just a little ray of light and she's obsessed with these things as well. And these things are called unicorns. And what we're talking about in the business sense is a business that is valued at over $1 billion that's privately held. And the reason it was coined a unicorn was because these are very mythical creatures. Remember when we talked about all the companies that Techstars and venture funds and Y Combinator invested in, and they're hoping that one of them takes off? Well, they're looking for a unicorn. They want that one mythical business to pop off so big that it saves them from all of the other bad investments that they made. So examples of this would be SpaceX, that's valued at over $1 million, or ByteDance, which is the company that owns TikTok. And some of these companies that you hear that were unicorns, they eventually went public, like Uber. I don't know if Canva. No, I don't think Canva is public, but Canva's worth over $1 billion. And when we talk about value, this is the next really important thing to talk about, because valuation is something that is thrown around a lot and it can be very hard to understand. Now, Shark Tank makes it look super simple, right? They come in, they say, hey, sharks, I just invented a new type of slime and I'm asking for $50,000 for 1% equity in my slime company. And then Mr. Wonderful will do the math and he's like, whoa, so you think your slime company is going to be worth $50 million? I might have not done that math right, but run with me, whatever it is, okay? And so they always say, whoa, you're valuing your company at this much amount. How did you come up with that number? And the thing is there's many different ways to determine how much a company is worth. So there's many more that I'm going to talk about right now. However, I would say that the most common would be the times revenue method. And the times revenue method basically means you're going to say, what is this company's revenue for the year? So that's just how much money they took in, not their profit, but their revenue, meaning what were their total sales for the year, not what did it cost them to make the product? What does it cost for overhead? What does it cost for blah, 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 blah. We're talking about revenue. And then they say, okay, this is a tech company, so we're going to take the revenue and then times it by 3 or 5, and that's the value of the company. And that's a typical multiplier for a tech company. Or maybe a service firm, like a marketing firm, you might be looking at a revenue multiplier of 0.5 to 2. So if you have a marketing company and let's say it makes $1 million a year, you might sell your marketing company and get $500,000 for it. Maybe you get $2 million for it if you have really good IP and data and team members or whatever it is, right? So times revenue is very common in small businesses, especially. So as you learn about small business sales, that's typically what they look at. However, it's not really a great indication of what the value of a company is, because who cares about revenue? Okay, another intermission. I'm sorry, I'm going so many tangents today. Another intermission of another thing that grinds my gears are all of these online business people that are touting their revenue numbers online on social media, saying, I made $70 million selling my courses. And yes, there is an online creator who talks about how she's made $70 million over the lifetime of her company selling courses. There's another very popular creator who's now claiming $33 or $35 million in total sales of their online courses. I'm not saying this is not possible. It's very possible, but it does not give you an accurate representation of what the company's performance is, because what matters more than revenue is profit. If you are making, let's just make the numbers easy. You're doing a launch and you're going to launch a course and you are going to make $1 million in revenue from the sales of that course. Congratulations. That's a huge accomplishment. But what we need to keep in mind is, how much money did you spend in order to sell that course? Did you run ads on Facebook? Did you pay a team of customer service professionals? Did you film it with a videographer? Do you have subscriptions? Like, what are all of the things that go into producing and then marketing for sale the course? You could very easily spend hundreds of thousands of dollars to get $1 million in revenue. So if you have $1 million in revenue and you spent 50 grand to put the whole thing together and market it, that's great margin. And margin is typically referred to as the amount of money that you made above your expenses, right? It's like, what's your margin? Like, you want great margin. A big percentage is profit. If you're spending $900,000 to make $1 million, you're only making $100,000 in profit. That's not a huge profit. That's 10% margin. And when I say it's not a huge margin, it's not a huge margin in online course sales. Okay. As an example, margins in businesses are going to be so different. The margin on a perfume company is going to be different than a mattress company, is going to be different than a computer company, is going to be different than a software. Everything has different margins, and there's usually industry standards. So there isn't like one good margin to hit. However, as we go back to valuation, what you're going to hear a lot of is an earnings multiplier, or what's called a PE ratio. And this is a better way to determine a company's value because it's a more reliable indicator of the financial success than revenue, because we're looking at profits against cash flow. So price to earnings ratio, again, PE ratio, is helping you assess the value of a company's stock. And just to give you an idea, like Apple's PE ratio is like 29 or 30, but the historical PE ratio of Apple over the last 10 years is 20. Okay. So right now you're like, oh, wow, the PE ratio is like 45% over the historical average. Is that good or bad? Well, again, it depends. Different industries have different ranges. And typically when you see a high price to earnings ratio, it is suggesting that this looks like a company that's going to grow. Like this is a good sign. A low PE might be preferred because it means that, okay, expectations are kind of like tempered. We don't think anything crazy is going to happen here. We're not looking for a hockey stick. I feel like I'm already in an intermission, but we have to take an intermission from the intermission to say what a hockey stick is, because that's another term that comes up a lot. Hockey stick or up and to the right are two very common phrases you're going to hear in finance or things like startup world, which is basically, if you think about a chart, over the bottom line, which is the x-axis, you have time, and going up on the axis, the y-axis, you have money. And so what you want to do is make a shape that looks like a hockey stick. So it goes over, and then it spikes up really quickly. In a fast amount of time, you get a lot of revenue, goes up very, very steep. It looks like a hockey stick. Up and to the right is indicating the same type of thing. And essentially, a hockey stick is the dream for a startup. Remember, you're raising money, so you're putting fuel on the flames of your business to get it to grow really, really quickly. And I don't want to say go up in flames because that's, I don't know, like bad business juju or something, but you get my point. You want it to go up and to the right really quickly. And in startup world, that's very common. That's very wanted. In small business world, I don't run a startup. I run a small business. I have said always that my philosophy on growth is long garden steps. And this is my own term. This is like Amber's couple dictionary for finance. Have you ever been in a garden, like an outdoor area on vacation? And they have these steps as you're walking from one place to another. You're walking down or up. And it's 1.5 awkward steps. So you can't get a good stride on these steps and you're like stomping and falling as you're trying to walk down these steps awkwardly. The steps are very long. And that is annoying to walk on in a garden. But in business, what that shows me is that I have some stability, and then I make a strategic pivot, and then I grow a little bit more. And I go up and then over. I take a little bit up and then I go over for a long time. So for me, that's been my philosophy. And that's what we've achieved in the business. So hockey stick is another thing to think about. And again, what PE ratio is good? It depends on your investing style. It depends on what type of investment you're looking for, whatever. You should just know a PE ratio is a way to evaluate the value of a stock. And the last piece that you need to know about this is market cap. That's just the total, value of the business. That's calculated by multiplying the share price by the total number of shares that have been issued. So for example, Apple's market cap is like $3 trillion. And essentially that's to compare one business size to another. And so when you look at a company's market cap, how much money is out there, like NVIDIA's market cap is insane right now. And you have to say, like, what is their price to earnings ratio? And does that make sense? Is this a good place for me to invest? And listen, that's a whole nother episode of how to evaluate stocks. And this is not financial advice, but if you don't know how to evaluate stocks, I don't recommend buying individual stocks because it's just the same as putting something down on the roulette table. Honestly, it is. So this is not financial advice either, but go listen to my episode about investing and let's talk about index funds. And I think that's going to be the last one for this episode. But let's talk about index funds because I think these are really important because I came up with the best the best analogy ever for how to explain what an index fund is, okay? So an index fund is a collection of stocks, securities, whatever, that is tracking an index. What is an index? Like the S&P 500. But everybody's always asking, what is the S&P 500? Who picks? Well, Standard & Poor's is the company, and they have 500 of the top performing companies in the US. And the nice thing about the S&P 500 is that it automatically adjusts. So if somebody falls out, they're now at 501, you're out of it, and we pull in the next company, and they get immediately added into the S&P 500. So here's where the analogy comes in for my Bravo fans. I said this on another podcast. I think I explained it poorly on an earlier episode of Old Money, but we really nailed it on another podcast that I guested on. So I have to share it with you. On Bravo, I'm a Bravo queen. I know everything that's going on all the time. And if I were looking at every Bravo show as an individual stock, i.e. in the S&P 500, you have Apple, Tesla, you have Uber, you have Nvidia. If you look at the Bravo lineup, you have individual shows, Vanderpump Rules, Summer House, Martha's Vineyard. You have Real Housewives of New Jersey, Real Housewives of Beverly Hills. Think about each of these shows as an individual company because they actually kind of are. Each of these shows has their own cast, their crew, production company, etc. And so Bravo has pulled together all of these different shows just like an index would in all of these different companies, right? So if you're watching Bravo in February of 2023, you're watching the season before Scandival breaks, and you're playing individual stocks. Let's pretend there's like a stock exchange where you can trade TV shows. We were all selling that shit so fast. We're like, Vanderpump Rules is boring. So boring. Sell this. I don't want to watch it anymore. I can barely tune in. However, I remember where I was the moment that I saw the TMZ article that said Tom is cheating on Ariana with Raquel. And I was like, this is not true. I was literally standing in my kitchen, looking out the window, watching my dog eat her breakfast because she gets nervous if I don't like stand right by her. So I sit with her a lot or stand by her while she eats breakfast. And I remember sitting there and I was like, this is not true. And then I saw it was on James Kennedy's page and I was like, what is going on? I don't follow James Kennedy, by the way, but I saw that somebody else had posted that he posted it. So I was like, what? This is no way this is true. If I was playing individual stocks and I sold my Vanderpump Rules stock because in February it was boring, in March Scandival broke, I would have missed out on so much growth of the popularity of the show the same way I would have if this was the popularity of a stock. And it's the same thing with Real Housewives of New Jersey. I was totally into it the last couple of seasons. I love the House Husbands of New Jersey. I think they're hysterical. However, this particular season of Real Housewives of New Jersey is the worst performing season of Real Housewives of New Jersey of all time. So I would have said, that's a show that I like. I'm emotionally invested in it. I would have made a bad investment decision to have that be a part of my portfolio. Same thing with Summer House. I don't even watch Summer House. I just started recently because people were saying how good it is. Now I'm totally into it, but I wouldn't have bought Summer House 2 years ago or 3 years ago when all of the OGs started watching because I just wasn't into it then. But now look at how much it's grown, all the popularity around the Carl and Lindsay drama and the Loverboy drama and the toast, all the things. I would have missed out. So instead, the better move, if I believe that the future of reality television will grow, and I know that Bravo produces some of the best reality television, even if some of the shows explode when I don't expect them to, and even when some of the shows tank when I don't expect them to, if I just invest in the index fund of Bravo, I'm trusting that Andy Cohen will make the right decisions and put shows like this season of Vanderpump Rules on pause, or put Summer House, Martha's Vineyard on pause, or bring back Real Housewives of Miami. They're rebalancing the portfolio. So instead of me having to worry about all the drama that's going on each individual show to say, is this show going to be successful? Because that's what people are doing when they're day trading, sweetie. They're looking at all the drama in the company. They're looking at that drama in relation to the other company's drama. That's the competitor or the next door neighbor or whatever else. And they're making their decisions on what companies they want to buy the same way you're making decisions as if you were buying stock in a television show. And so that's why I love index funds, because I don't have to tune into the drama. I just have to believe, and this is my personal belief, this is not investment advice. I just have to believe that the United States of America will continue to be an economic powerhouse with great businesses within it that support a lot of activity for the global economy. My personal belief is that the economy will probably dip. It will go up and down. My portfolio will swing, but overall, in the future, it will grow. That's my personal belief. This is not investment advice. Same way that I also believe that even when Bravo has a flop, they'll still come through and surprise me with something that's so freaking good, like Dance Moms last year that I was obsessed with. It wasn't Dance Moms. Oh my God, it was Dancing Queens. It was the most absurd show, but I loved it. And now they have all of these things in the Bravo vaults that they're bringing back, and people are getting reintroduced to Flipping Out. Oh, that's another one. I never watched Flipping Out. And now I'm obsessed. I'm like a Jeff Lewis stan. I'm obsessed with everything Jeff Lewis. I went and downloaded all of the more recent episodes of Flipping Out off of Amazon. Like that's how much I got into it. But just like Jeff Lewis said, he was surprised when he got his show canceled after 11 seasons. And if you were a fan of the show, you probably would have thought that would have gone on forever too. But you can't predict something like Nene leaving the show. You can't predict something like Kim Zolciak and Tardy for the Party going on for like 6 or 7 seasons and being super successful. It's wild, which is why, again, my low cortisol life loves an index fund because I can just invest in the index that's being tracked without me having to think too hard about all the drama that's going on in the company. And with that, I'm going to leave you for now, not forever, just for now, because I thought this was going to be a fast episode. How dumb am I? I was like, oh, I'll probably do this one of my 30-minute episodes. No. We're not even halfway through the list. So the next episode is going to recap the rest of the topics that you need to know to be the smartest and most charming girl at the summer house. Our next episode is going to talk about real estate terms. We've got a lot to discuss with Tom and Ariana. We're going to talk about some shopping stuff that I think is going to go really well, especially if you're going to like the Dubai Mall, which we need to talk about. And I'm wondering if we should talk about fashion or if I should save that for our big fashion episode in September before all the fashion weeks. But I think there's a lot of us that are mispronouncing some of the big names, and I want to tell you what to be on the lookout for in fashion for summer 2024. Okay, we need to talk about it. We'll touch on it. Okay, unicorns, love you so much. I'll talk to you on the next episode. Feeling rich? I hope so. Thank you for joining me on this episode of Old Money. If you have questions you want answered, email me at oldmoneypodcast@gmail.com or hit us up on social. We are at Old Money Podcast, and I am at your service. If this episode spoke to you, inspired you, helped you, if you took a single note, it would mean the world to me if you could please just take a minute to rate and review the podcast. And if you're not doing so already, subscribe. And if you have friends who like getting rich, please share this episode with them, even if it's just on your Instagram story. And I'd love you more than Jeff Bezos loves Amazon Prime. Thank you so much, and I will talk to you on the next episode. Remember, I'm not your lawyer, I'm not your tax professional, and I'm not your financial advisor. The content presented in this podcast is intended to entertain, educate, inspire, and support listeners in their personal and professional development and does not constitute business, financial, or legal advice. In addition to that, this episode may contain paid endorsements and advertisements for products and services.